Hello and welcome back to the Introduction to Investing Masterclass. This is Module 6 and it focuses on inheritance and succession. Over the course of this three-part module, we'll outline what you need to know about inheriting a property, explain bare trusts, and provide an introduction to business succession. The passing on of a property can be a challenge to talk about, but it's a very important topic to address. Without discussion and a good plan, there is the possibility of large tax bills. When transferring a single residential property to a child, capital acquisitions tax rates apply over and above the relevant tax-free threshold. The current parent-to-child tax-free threshold is $335,000, but bear in mind that this could change. Just 15 years ago, the parent-to-child tax-free threshold was in the region of $500,000, so the general trend in recent years has been downward. To take an example, using a fictional client called Kate, who will inherit a residential property that is valued at $1 million, under the tax-free threshold, Kate is entitled to $335,000, but she must pay 33% capital acquisitions tax on the remaining amount of $665,000. Beneficiaries may need to pay their CAT bill within the same tax year that they inherited, which could mean Kate only has a very small amount of time in which to pay a bill of €219,450. Depending on her financial situation at the time, this could cause a cash flow problem for Kate, depending on the market conditions for property or if she does not wish to sell the house, but it can be avoided with a bit of planning. One way Kate's parents could plan for her inheritance tax is to use the proceeds of a Section 73 savings plan. This plan can offer the option of paying a beneficiary's CAT bill on a gift without the payment itself being considered a further taxable benefit. These savings plans need to be in place for a minimum of 8 years in duration, and if the owner of the Section 73 savings plan dies within an 8-year period, the value of the plan will not qualify to be used against either gift or inheritance tax. So it's worth setting up such a policy early. A property gift made alongside a Section 73 policy provides the child with a property and a means to fund the gift tax liability. The beneficiary's tax bill is paid for in a tax-efficient way. Importantly, future capital appreciation on the property will accrue to the child for whom no charge to CAT will arise. This can work especially well when the asset being gifted does not attract capital gains tax for the parent transferring the asset and where the stamp duty liability may also be minimal. Kate's parents could also put in place a Section 72 life insurance plan. This is a policy which tax efficiently covers the inheritance tax bills of the beneficiaries of an estate. Put simply, it allows the beneficiaries to inherit assets without then having to find the money to pay a significant tax liability. If Kate did not want to sell any assets to pay her tax bill or couldn't do it quickly, it might be a useful option. You may have heard of the dwelling house exemption regarding the gift or inheritance of a residential property, but the conditions to avail of the relief can be very difficult to satisfy. In the case of an inheritance, amongst other conditions, the beneficiary must not own any other dwelling house or hold an interest in any other dwelling house in Ireland or abroad. The beneficiary also needs to have occupied the property as their main residence throughout the 3 years immediately preceding the date of the inheritance. So that's some of the most important elements in relation to inheriting a property, and hopefully our practical example aided your understanding of this topic. There are, of course, other property transfer options, so if this is something you want to learn more about, be sure to talk to an advisor to discuss your situation. When it comes to inheritance planning, we understand that it may involve uncomfortable conversations, but it's worth talking openly about this and consider ways to prepare yourself or your beneficiaries for a potentially large tax bill to maximise the benefit of the gift or inheritance. These talks are worth having now. It will make things easier for those left behind and help to avoid future confusion, conflict or erosion of property wealth. Coming up in our next video, we will tackle the topic of bare trusts, a trust that can be used to gift money to children under the age of 18. I'll be back with you shortly.